Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Verisign Inc. This was a subscriber request to look at the stocks. We're going to take a look at them, do a stock analysis on them. I'm going to tell you what I think. But before we get into the stock analysis, of course, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos and some other stuff. So if you want to get good ideas on potential stocks to buy or value traps to avoid, make sure to subscribe to the channel and make sure to keep watching the videos because I go through the financials and seeing how to interpret and understand them will help you as well and hopefully help you make better investment decisions. So Verisign Inc., I'm very appreciative that the subscriber requested this because this was not on my radar before, and I've gone through the financials, and overall there's a lot of good underlying fundamentals here, but we're going to dive in, see the pros, the cons, and possibly what might be a good price to buy on Verisign Inc. People may not know who Verisign is, but basically they kind of are one of the main, like the only database holder for basically all the .com and .net and some other, top level extensions, basically, for the world of domain names. So they have a built-in monopoly, which is very good. And also a little has its drawdowns too, because they are price capped basically on how much they can increase prices. And this is kind of one of these things you kind of have to factor in. So we're going to go, first of all, look at some of these other little metrics here. You can see basically the group focus value band staying potentially a little bit undervalued. We're going to see if this is accurate. Sometimes for more consistent, predictable companies, it is. Other times it's not. They basically right now are currently sitting at a PE of 23.92 and have a forward PE of 23.53, meaning they're not expecting very large EPS growth the next year, which, may be the reason they're already down a little bit right now. And they don't do any dividend, but they do share buybacks. So let's jump into the financials here. You can get a kind of idea of the stock on the right-hand chart here. Revenue trend line just up, up, and up. Basically, when you're the government endorsed like kind of authority for registering domains, you're going to have always a built-in base. And basically, what this means is anytime someone has a .com domain or a .net or some other ones, basically Verisign gets some revenue off every year off a new domain or renewal basically domain there. And you can see last 10 years growth, 5 years very consistent around 7-8%, and EPS a little bit higher because they're basically doing those share buybacks. Let's scroll down, start looking at the financials here. And it's like, we're going to go through this, and this is all going to be like, just there's not going to be really a lot of negatives at all. You can see basically top level revenue growth is growing. They've been increasing their gross margins over time. They have got them already pretty high. So at this point, when you're already at 86, 87%, it's very unlikely they're going to be able to increase these significantly in the future. Selling in general, admin, R&D is extremely low because there's not very much for them to do, period. One thing I will mention, I think this was in 2018, 2019, they did sell off another portion of the business and kind of just decided to focus really on just their core business. So this does kind of tell you that they're really not going to be expanding to anything out, and they're just going to stick with this one monopoly they have. So that's really all we're going to be valuing it from, and there's not going to be a little very much surprise on the upside or the downside in their business operation. And then you can see after total operating expenses, well, the same thing for operating margin. Operating margins have basically grown with the gross margins. So this is great. Typically when your gross margins and operating margins are going up, it means you have basically a more competitive mode, as I say in a lot of other videos. When you have you're already built-in monopoly there where you're the database for all those domains, you of course you have a monopoly, and of course you have a moat. There's no one else can basically have this moat. They do have a little bit of interest expense, although it's relatively low. So this is a great ratio: $75 million of interest expense. They also have interest income. Well, recently, I wouldn't expect this going into forward in the future because this is more because of the higher interest rates. But basically, they have $1 billion of operating income, and even if we don't include the interest income and just the interest expense there, they still have a great ratio, kind of above that 1 to 10 I really like. So very healthy overall, leaves them a good pre-tax income. Taxes, relatively low, standard, kind of what you would expect for like an American company, and that just all kind of just flows down to the bottom line where you got positive income and over 50% net margin, almost 55% now. So that's pretty good. And you can see over time, the EPS has been going up, which is further boosted by a little bit of basically those share buybacks. So, just overall, very just easy to understand, very clean balance sheet, looks very, very good. Our financial income statement. Now we're going to look at the balance sheet. So What do we see? Basically, total current assets just around $1 billion. They got a little bit of cash and cash equivalents and marketable securities, which is earning them that interest income. And then you can see in comparison, total current liabilities is about 2 billion, which not the greatest current ratio, but it's really not real liabilities in a way. It's just basically deferred revenue. It's not like they really have their debt they're owing to someone in there, but basically they do only have total assets of about 1.75 billion. Overall, this business really does not require a lot of assets. They got some, buildings and a little bit of infrastructure there, but other than that, this is really just, all software at the end of the day, and they have a negligible amount of basically goodwill, and even their intangible assets for the type of business they are pretty low to none. And they do have a little bit higher on the total liabilities and the long-term liabilities, just as because they have some long-term debt, almost 1.8 billion, which does put them on negative equity, which isn't the greatest thing. It's just you have to keep in mind. I really wouldn't be concerned though, because they have this almost $8 billion of debt, and they're only paying $75 million of interest expense. So if you do the math there quickly, that interest rate is quite low. They could pay it back. I think they just kind of are taking it because it's, gives them some cheap money they can get, which they feel they can get better returns by basically buying back their shares, I guess. But, we'll see if they ever want to pay back the debt in the future, if they keep getting favorable rates. I doubt they will, but if interest rates stay high, maybe they would, something to keep in mind. But realistically, this debt is probably going to be staying, and they're just going to kind of roll in the future unless it gets significantly more expensive. So doesn't really matter too much. Cash flow statement here, pretty clean cash flow statement again. You got great cash flow from operations, a little bit of stock-based compensation, not very huge. You look at cash flow from depreciation, and compared to that, the purchase of plant, property, and equipment, more or less basically at replacement value, what you would expect for this type of company. You basically got a bunch of tech people sitting in some offices and some servers, and you're just kind of maintaining and keeping them growing at this steady pace. And this basically purchase of investment, sale of investment is usually basically from the marketable securities, the treasuries. They're probably buying and selling them because you got to do something with extra cash or currency hedging and stuff like that. So that's not really anything there. And like I said, there's not really, other than the past here where they did some acquisitions, they're not doing any acquisitions, and they're basically signaling they're not going to be doing any really in the future because they wanted to stick to this core business. So pretty boring financial statements overall. You can see where they are putting the money, they're basically returns here, is they're repurchasing stock with it all. So every year, all that extra cash they have, they just buy back their shares. I personally think it would be a little bit better, split this a little bit between repurchase of stock and cash flow from dividends. You could maybe pay out 30% in dividends and 70% in stock buybacks, because, when you kind of do stock buybacks just all the time, it kind of keeps the price high, and then you're always kind of buying back relatively high. So I think a little bit of a split would be better, but it doesn't look like they're doing that. At the end of the day, it doesn't really matter like too much at all. And you can see basically positive free cash flow, no really big problems with that. So they got free cash flow and they repurchased stock with it. Very boring, very clean, financial statements. There's no really concerns, no red flags. So all this really comes down to is a valuation question. What really is Verisign worth, and what's a good price to pay for it? So now this gets into what I like to do and kind of look at more of a little bit of a relative analysis. So for a stock like this type of analysis is very good to do because it's based off boring consistent companies. And what do we have? We have a pretty boring consistent company here. So you can pop up the revenue with estimate here, you can pop up the EPS with estimate here. You can see basically even projections in the future expected to keep growing. And let's get rid of those now, and let's basically pop up the PE next. And you can see right now, this stock is kind of always traded at a high PE. Sometimes it gets up to 40. That's when it's very expensive. You probably want to basically be selling it. And now when it gets into the lower 20s, that's when you likely want to be buying it. You may be looking back here and saying, oh, well, it's a lot lower right here. And I always say what you have to do is you have to see if there's any anomalies in basically your margins there. So you pop up the net margin. Of course, what do you see? Well, there was abnormally high, basically, net margin during that time, which was why the PE was abnormally low. So when we kind of adjust for that and look at things in the greater context, the stock is relatively cheap to kind of like they're more or less their, past performance from a PE ratio metric here. And then we can also look at the price to sales. Price to sales is highly dependent, basically, on what their net margins are at the end of the day. So when we look at the price to sales ratio, they are trading at a 13. They do have very high margins. and this has gone up a lot before, this is the range they were trading in. But let's pop up those net margins again, get those going, and we don't see that odd thing there. And also make inner C, get rid of the price, maybe even get rid of the price to sales. And you can see before back here, they were trading at a much lower net margin of like 35, where now they're up to basically 54%. So you kind of do the ratio of that, and that kind of actually does to some degree actually like entirely kind of, justify this higher PE. If you were, kind of cheap before at like, an 8 or a 9, 50% higher net margins, well, 50% higher price to sales ratio leads you pretty close to what we're looking at basically today. So let's pop into the stock chart here. You can see I've already popped in a little bit of basically, my channel, technical analysis, sort of that there, kind of the overall trend that I think from the fundamentals and technicals it's going. And you can see the stock basically got a little bit ahead of itself, overvalued. This is also when they were kind of selling off that part of the business instead, that we're just going to stick to our core competency. Now they've just been going sideways. There hasn't been any big crashes. They're always bought back up. And, they could potentially go lower than they are right now. But, they also could support here. There's a little gap fill there, which is just a technical potential buy point. So, I actually now have this basically stock on my radar. I may start selling some puts on it, or even start dipping my toes in it, because right now it's in a little bit of a short-term downtrend. Let's go on the daily chart here. You can see it's just kind of sliding down. At some point, it's going to find some support. Like, I can't predict if it's going to go straight up, it's going to base a little bit. This is one of these things that, if you're interested in the stock, you believe there's not going to be some black swan event where they kind of get wiped out, which is really the only major downside you have, or a very significant repricing in their multiples earning. That's also something that could justify a lower stock price as well. But, if you kind of believe that things are going to be ticking on in the future, which, is a reasonable assumption to have, when you do get to these lower levels in the stock, that would hypothetically be the time to pick it up. It can bounce back up, come back down, but eventually I probably would expect this to start taking off. If we were looking at the kind of EPS estimates there, I'd done a little bit of math before, but, it was looking 2026 was going to be like just $9.36 estimated EPS. You give it a little bit higher PE than it is right now, 28, which is, not too high, not too low for it. I think that's more of a fair value. It puts the stock at about $260. So that kind of, gives you an idea that in a few years, basically in 3 years, that's what it could be worth. So, but anyways, that's my stock analysis on Verisign. I thank the subscriber for mentioning it. Now my watch list, so I'm probably going to be buying it. We'll, see exactly how much I buy and, when I want to buy it. But, tell me your thoughts on it. If you want me to look at a stock, drop it down in the comments. Of course, subscribe to the channel, like the video, and I will see you in the next stock analysis.